Citi Bank has drastically revised its price forecasts for Bitcoin and Ether, signaling a possible shift from institutional optimism to caution. This development raises serious concerns for crypto investors about the future of the market. Here's what you need to know. Looking ahead, we can anticipate several potential outcomes for Bitcoin as it navigates a volatile market landscape. Recently, Bitcoin has faced significant fluctuations, with prices testing crucial support levels near $58,000 to $59,000. Analysts emphasize that there is currently an 81% chance Bitcoin could rise above $65,000 in the coming weeks, driven by renewed investor interest and shifting market dynamics. However, if ETF outflows persist, this may prompt more banks to revise their forecasts downward, potentially accelerating further price declines and shaking investor confidence. The backdrop to this situation includes the growing participation of institutional investors, which has historically influenced Bitcoin's price trajectory. As traditional finance increasingly embraces cryptocurrencies, the stakes are higher than ever. The current market conditions have also seen long-term holders retaining a record 16.5 million BTC, as noted by Matt Hugin of Bitwise. This unprecedented commitment suggests that many investors believe in Bitcoin's long-term value despite short-term volatility. Furthermore, regulatory developments loom on the horizon, with President Trump scheduled to address a major crypto conference on July 6, 2026. This event is expected to clarify federal digital asset guidelines, which could significantly impact market sentiment and trading behavior. These regulatory frameworks may either bolster confidence by providing clarity or stifle growth if perceived as overly restrictive. As we navigate this uncertain landscape, investors must weigh the short-term risks against the potential for recovery. The commitment of long-term holders serves as a counterbalance to current market fears, indicating a belief in Bitcoin's enduring relevance. In this context, strategic planning becomes essential. Investors should consider diversifying their portfolios while remaining vigilant about market signals. The upcoming regulatory developments and the behavior of long-term holders will be pivotal in shaping Bitcoin's trajectory in the months ahead, leading to a potential resurgence or a deeper downturn. The downturn we are witnessing today stems from a confluence of factors affecting the cryptocurrency market. First, the reversal in ETF flows is significant. After months of record inflows, spot Bitcoin and Ether ETFs have now experienced net outflows, which has eroded the primary demand driver for institutional adoption. This shift indicates a waning interest among institutional investors who had previously driven market enthusiasm. Furthermore, these ETFs were seen as a gateway for traditional investors, and their decline signals a broader retreat from riskier assets. Additionally, macroeconomic pressures have contributed to this challenging environment. Rising bets on interest rate hikes, combined with tech stock sell-offs and weak U.S. jobs data, have fueled a risk-off sentiment among investors. The broader financial landscape is increasingly cautious as inflationary pressures continue to shake confidence in various asset classes. The recent spike in consumer prices has made investors wary of speculative investments like cryptocurrencies. Moreover, MicroStrategy's significant losses, amounting to $12.5 billion on its Bitcoin holdings, have exposed vulnerabilities in corporate Bitcoin treasury strategies. This revelation raises questions about the long-term viability of holding cryptocurrencies as a treasury reserve, prompting companies to reconsider their approaches. This situation is compounded by ongoing regulatory uncertainty. While the U.S. Treasury has begun to emphasize the need for federal digital asset guidelines, the lack of finalized rules has left many investors feeling cautious and hesitant to engage fully. The absence of regulatory clarity stifles innovation and can deter new market entrants. Looking ahead, the cryptocurrency market may remain under pressure until clearer regulatory frameworks emerge and macroeconomic conditions stabilize. The next few months will be critical for digital assets, as investors seek greater assurances before committing significant capital once again. Citi's recent decision to cut Bitcoin and Ether price targets signals a critical shift in sentiment among institutional investors. This move has already resulted in immediate consequences for the cryptocurrency market, with Bitcoin notably dipping below the $59,000 mark amid negative exchange-traded fund (ETF) flows. These outflows can exert additional pressure on prices, raising concerns about the near-term stability of these digital assets. The reduction in price targets reflects a broader trend of diminished confidence among investors, prompting many to reconsider their investment strategies. As a result, we may see delayed or reduced allocations to cryptocurrencies, with investors wary of a potential further downturn. The implications of Citi's actions are significant and far-reaching. JP Morgan has highlighted systemic risks associated with this environment, particularly focusing on companies like MicroStrategy, which holds about 4% of the total Bitcoin supply. If Bitcoin prices continue to exhibit weakness, the aggressive trading policies of such firms could create volatility that extends beyond the crypto market and into traditional financial sectors. This risk is compounded by the interconnectedness of institutional investments, where a downturn in one asset class can reverberate across others. For long-term holders of Bitcoin and Ether, this situation serves as a crucial moment for reflection. The current capitulation, marked by miners offloading their assets, raises questions about whether we are witnessing a market bottom or signaling a deeper decline. The average person should pay attention to these developments, as the performance of cryptocurrencies can directly impact broader financial markets. Fluctuations in digital currency values influence investment portfolios and affect retail adoption of cryptocurrencies, which could slow down if confidence wanes. Looking ahead, the outlook for cryptocurrencies remains uncertain. While some analysts believe that a rebound could be on the horizon, others caution that further declines may be inevitable if investor confidence continues to erode. The coming weeks will be crucial in determining whether the market can stabilize or if we are in for a prolonged period of volatility. Stakeholders across the spectrum must remain vigilant, as the unfolding landscape will likely shape the future of digital currencies and their role in the global economy. Investors should brace for potential shifts and adjust their strategies accordingly. On June 30th, 2026, Citi Bank officially lowered its price targets for Bitcoin and Ether, signaling a significant shift in the cryptocurrency market. The bank cited a notable reversal in U.S. spot ETF inflows, which have turned negative after months of robust institutional buying. This downturn starkly contrasts earlier forecasts from firms like CoinShares, which had predicted that Bitcoin could soar to between $120,000 and $170,000 by year-end. Currently, Bitcoin is trading below $60,000, marking a staggering decline of more than 50% from its all-time high of nearly $130,000 achieved just a year prior. This situation is compounded by the fact that Bitcoin is experiencing its first back-to-back quarterly losses since 2022, a trend that raises concerns among investors. The context behind this decline includes a broader market correction in the cryptocurrency space, which has been influenced by tightening monetary policies and regulatory scrutiny. Investors had previously shown a strong appetite for Bitcoin and other digital assets, driven by institutional adoption and the promise of high returns. However, recent macroeconomic factors, including rising interest rates and inflation concerns, have led to a reevaluation of risk assets, particularly in the volatile crypto market. The shift in sentiment from a major financial institution like Citi is particularly alarming, as it could exacerbate the ongoing bearish trend for crypto investors who had hoped for a recovery. The impact of Citi's downward adjustment on the market cannot be understated. It raises questions about the sustainability of previous bullish trends and could lead to further price declines as investors reassess their positions. Additionally, this shift may deter new investors from entering the market, fearing further losses. The overall sentiment among institutional investors appears to be shifting, marking a departure from the optimism seen in earlier months. Looking ahead, the outlook for Bitcoin and Ether will depend heavily on macroeconomic conditions and regulatory developments. If the current trend continues, we may see further price corrections. However, should institutional confidence return, there is potential for recovery in the latter half of the year. The next few months will be critical in determining the trajectory As we consider these potential outcomes, how will you prepare for the shifts in the crypto market? Share your predictions in the comments, and don't forget to subscribe for daily deep dives into financial news.